So I mentioned the VIX. That is very interesting. As I mentioned, we've seen the VIX drop down to levels here below 14 now. We haven't seen this in quite some time. We've seen little brushes with this in the past couple of months, but we haven't seen it consistently at these levels for a while. Let's take a look here at the VIX. Now we know it's at 1334, it's down 27, not that bad. Let's take a look at the stock chart. There we go. And of course, as I mentioned, we flirted with some of these low values in the past couple of months, going down to 16. Talk about support and resistance here. We see some of that looking like, hey, it's not going to drop below 16. Flirted with it, then came back up to 14, flirted with it again. Had that increase up here up to 16, and now we're back into these levels. All right, and we're seeing sort of a pullback here. This is using the Bollinger Bands, of course, and at the same time, we're also looking here at this level also with the MACD. Sorry about that, folks. Now, taking a different look at this, let's go back further in time. Instead of 3 months, I want to go back about 3 years. It's going to look a little jumbled, I understand that. But we've had all of these different ups and downs since, naturally 2020 into 2021. And we see here some brief flirtations with the values we're seeing right now. Let me change the color here so it shows up a little bit better. But we had some brief flirtations with these lower prices in the 16 ranges back here in about 2021 during that melt-up market. A little bit later on in 2021, and then we've been things kept happening, right? 36, 34, we know all about those. But we've been in a consistent decline, and we're here now in this $13 to $14 range. And seeing that volume on the VIX calls at this point is really intriguing for me. And the reason why is that when these are at these levels, buying VIX calls is an interesting broad market protection hedge, because if something happens, they come out and they say they're going to start doing new interest rates, or that the interest rates hikes go on, or inflation peaks up. We saw recently that inflation had cooled again for the month of June going into July. But if we start seeing inflation spike again, if they start talking about raising rates now that they've talked about flattening out, we might start seeing this move up. And that, of course, will be because there's panic in the market. There might be some selling. There might be some fears after we've had this strong run with SPY up above, or trading right now around 4,500. And so these might be some calls to consider. Puts on SPY is a good broad market hedge. Puts on QQQ if your portfolio is tech heavy, putting 2 to 3% in that type of protection. But we had some great results using VIX calls as a hedge. Back in the earlier years, back in 2018, 2017 or so, I was buying calls on the VIX to hedge the bull put credit spread portion of my portfolio. And in an older webinar, we showed that, back in about February of 2018, there was a sudden drop in the market based on someone saying something that a trade war with China might be a good idea. And the 3 bull put credit spreads I had that were expiring on February 9th, they were all at a gain with 1 week to go to expiration, about a 30%, 33% gain with 1 week left to go to expiration. And that Monday, after that announcement was made over the weekend, the market took a dive, and those 3 positions were all at 50% loss on that Monday with 4 days remaining to expiration, or Tuesday, I think it was actually, with 3 days remaining to expiration. So in any case, let's see if we can find that here. Custom. And I want to try a custom view here from let's go further back than that. 110, 2018 to, let's go to 25/2018. All right. And here what we see, sorry, there's that February 5th, 6th, 7th, 8th, and 9th. It's in this range here. I had 45 day out, 18 calls on the VIX that I purchased. I think I purchased back here. So they were going to expire in March, if I'm not mistaken. And they are the 18 strikes. So this is the VIX was doing this here, went up to almost 40, 45, while my bull put credit spreads are naturally doing this because the market was tanking. The monetary value, what I did is I closed half of those. I think I had 8 contracts. I closed half of them here, closed another half here, and then closed the remaining 2 here. I think, and when it was about 30 to 35, I think it was right around 30. So the profit I made on those VIX calls countered almost perfectly the loss I took on those 3 bull put credit spreads, which had an average of about 5, or I think it was 5 contracts. I think it was 6 contracts average. One was 10, one was 4, and depending on the strike difference, and I think one was 5. So yeah, it averaged just above 6, I think, for those. But the profits on those 8 long calls for the VIX at that time almost equaled out the loss I took on those bull put credit spreads. So it was a complete wash, and I was very thankful I had those. And we did that a couple of other times with uncertain markets. But then, as we mentioned back in 2020, why weren't the VIX calls, I said 3 months ago. My apologies, folks. Let's go 3 years. Why weren't we using the VIX calls as a market hedge during that time back in 2020? And it's because, well, the implied volatility of the VIX options was too expensive to buy for a hedge. Even if you managed to guess right somewhere in this range and you had one of these spikes, it almost broke even because of the amount of volatility you're paying into them. This approach as a market hedge, to me, only works when the VIX is in these ranges and the volatility has been easing. And I hate to say it this way, but I have to say it. But when the implied volatility of the volatility index options are relatively low. This looks to me as a good time if you're considering a market hedge, concerned about the sell warnings you're seeing on our market sentiment tool. Yes, buying puts on SPY is a good hedge as well. Buying puts on QQQ, as I mentioned, or even the indexes if you want to do it that way. But this is another alternative to consider. The way the market's been, volatility has been settling. If you fear a market pullback or you fear an unexpected event that may cause market turmoil, now is looking like maybe a pretty attractive time to potentially buy calls on the VIX. Consider that, I should say, as a potential market hedge going forward. It seems like many others in the market are honestly believing that too. Now, these could be bear call credit spreads. I'll be honest with you. We're seeing high open interest on the 20 call and the 22 call. These could be investors buying VIX calls, expecting that a move in the VIX would give them profit. Or these could be investors that are selling. I mean, they're close to a 1-to-1 ratio. These could be investors selling the 20 call for July 19th and then buying the 23 call, creating a bear call credit spread on the VIX in that case, expecting that the VIX is going to stay low 5 days away because they're Wednesday expirations. So 5 days away to the 19th. That could be something considered. They could be speculating with bull call debit spreads too in the reverse. I'm just not sure. But I like this, almost 45-day out August 60 call. Oh, 60 call? No. I'm looking not that deep. That is odd. That's probably a calendar spread of some kind. September 60 and August 60, so far out of the money. Maybe there's just people speculating deep out of the money, buying calls. That does look strange to me, though, that there's so many at the 60 strike. Maybe someone is trying to do a calendar or horizontal. Man, that would be expectations of a big move up to profit on that. It's dangerous for me to say that. Maybe it's a long straddle. So I don't know if anyone would do a calendar straddle. I should speculate. I don't know either. And anyway, that seems very far away. Okay, so Doug, I'm sorry, not Don. Doug does ask, what would you look for when buying a call? I played around with it for multiple months. I played around with it for about 2 years to hedge the bull put credit spread portfolio, which usually the bull puts by itself would represent about 15% of my total portfolio value. Following the weekly bull put default search here, which is also shown, the top picks are shown in the weekly picks of the day for the bull put credit. But the general search criteria that I was developing at that time, is that weekly bull put default, where I'm essentially looking 14 days out in time, 2 weeks out in time rather than the weekly. I found that worked better over time for me based on the criteria I was using. So Doug, what I typically look for is after, trying different things, what I found worked best for me as far as the VIX calls went, when the VIX was attractive, when it was at its lower levels, when it was in the range it was, and I was worried about an unexpected event or things of that nature, I typically look for calls that were somewhere between 35 to 60 days out in time. So I'd probably go, maybe with this August 16th, I'd probably be leaning more towards the August 23rd. And what I typically just looked for was a delta of about 0.3. Oh, I'm sorry, these aren't the standard VIX. This is a VIX weekly. I do want the standard VIX. So maybe I'd go to September instead of that August. The standard September, 68 days away. I'd probably like to stay closer. I apologize. But what I would typically look for was the one that had a delta of 0.3. I felt that was a good enough range out of the money where if there was a spike, the return would work in my favor. So yeah, there we are, that 22 that we saw in the high open interest. That was for the shorter time frame, for July 19th, of course, but the 22 and the 20 is at 0.371. Either of these are pretty good, but I stayed out of the money, Doug. I didn't go in the money with the calls. I stayed out of the money for the lower cost. Honestly, in general, what I was looking for was the bid or the midpoint closest to $1. Just to keep it simple. Hey, I'm going to put $900 in. I'm going to buy 9 contracts. That's how I started originally with doing this. I was just looking for the one that had a $1 bid, knowing I was going to allocate X amount of money to this portfolio. I'm sorry, to this hedge, Doug. My apologies. Just to keep it simple, hey, let me take the dollar one. And usually when the VIX was at 12, I was buying the 16 or possibly the 17 strike. As I mentioned back in August, I think I had the 18 strike. I'm sorry, in February, I had the 18 strikes at that time in that February 9th to dip. But that was also at the time where I started to say, you know what, rather than just use the dollar, it has worked a couple times. Let me see, using the historical tools, which one seemed to give the best performance and the best return on these wild spikes. And to me, it seemed like it was around that 0.35 to 0.25 range. So I focused on the 0.3 delta, is what I did, essentially following up with that. To hedge the leverage portion of my portfolio, whether I was in bull put credit spreads, bull call debit spreads, diagonal calendar spreads, or poor man's covered call on higher price stocks that I can't afford in my portfolio to use as married puts or collar positions. That's just another hedge. It's just another hedge you can use to consider. But with the VIX at these levels now, I'll admit, honestly, it's coming back into my view as a potential hedge, but I want to give myself more time. When the VIX became too expensive, when the options on the VIX became too expensive because the implied volatility of the volatility index options was too high, you see here on my watch list pod, I've got some of the married puts that I'm in, AMD, ASO, ELF is one that Ernie's in as his box, Fortinet, NEM. It's going to open one this week, either on Delta or Pure Storage. I just didn't because I saw the sell warnings and we'd been so strong. I was worried about a slight pullback. So I'm going to take a look at that next week, but I'm probably opening 2 more married puts in the Fusion portfolio at Radioactive Trading next week. But you see here, I also have UVXY and VXX as things that I'm tracking. Why? These are the volatility ETFs. See, you can't buy shares of the VIX. To trade the VIX, as you know, we have to trade the options. Credit spreads, if we think, bear call or bear put debit spreads, if we think the VIX is going to be declining, that things are settling down, that would have worked well with a couple of hiccups in the past couple of months. Buying calls directly on the VIX, if we think we're at a low point and it might spike, this to me looks like a good time to maybe consider that, but I want to go farther term. But if I'm not sure about the time frame of when the market might change and the volatility might increase, and I'm not expecting a sudden jump unless a black swan event happens back up to that $30 or $40 range. But if it goes up to 19, if it goes up to 20, it might be a good hedge as an overall portfolio for some of the bullish or leverage bullish positions that I'm in. But if you don't want to so much worry about the time frame, about selecting the right expiration or the right strike price, as Doug mentioned, you may just want to consider buying shares of VXX, buying shares of UVXY that don't have an expiration date but will fluctuate similar to the VIX itself as far as an underlying goes. You see those little spikes here like we saw, but it's still been in a strong downtrend. We see some of the little spikes here when it happens. It doesn't move as much. And naturally, you're not going to see as high percentage gains as you would with buying calls on the VIX to hedge an overall portfolio. One of our older regular attendees, Sam, and I mean older as in from the past few years, hasn't been on that often recently, but has joined us once in a while. Sam, almost the same exact similar chart. He was preferring to use UVXY from time to time to hedge the portfolio or to trade for volatility fluxes. And that's why UVXY came on my radar, because Sam had mentioned it during one of these presentations. And I was using VXX at the time, and VXN, I think it was actually called. It transfers every few years, so now it's VXX. But I started evaluating UVXY as well. It's an ultra short-term futures position. So if we start seeing a spike in the volatility, we'll see a spike in UVXY. Percentage-wise, although the chart looks almost identical to VXX, and it pretty much is, but you start to see a little bit of fluctuation there in that case as well. And of course, you could do the calls and puts on UVXY as well, or VXX, but if I'm buying calls and puts, I prefer to use the VIX. If the VIX is too expensive, then I might be buying shares of UVXY or VXX as an overall market hedge. But then again, if the VIX options are too expensive, that's probably because we had a recent downturn and the implied volatility increased. I might not be looking to buy calls at that point. Oh, okay. A follow-up question here real quick on that. Let's go back to the VIX chart. And the follow-up question that came in is, do you buy puts after you see a spike? And the answer is no. I never played that route, because normally what happens after the spike? Again, as I mentioned, after you see one of these spikes to these tops here, the implied volatility of the VIX options is too high. It still probably would have been profitable if I picked the right time frame, maybe even here, to buy the put. But if I bought it at the wrong time here, paying into the higher implied volatility at the time, I might not have been looking as good as a profit in these ranges at that time, because this is where that IV, just like, trying to buy calls or puts going into earnings, the implied volatility is too high. So even if you do see the move you expected after one of these peaks, you might not see the percentage gain return you were expecting, because as it's falling down, as the market's settling, the volatility is dropping by definition, but also the implied volatility of the volatility index options are dropping as well. So you're having that IV dry up on your position, but it is going in the direction that you want. So I've never played it that way because I thought they were too expensive. It's possible that I missed out on some opportunities there, absolutely. Ernie does have that search. Ernie created a search here in the bear call credit spreads as a default. Oh, I don't have bear call credits up here, so let's go into other strategies very quickly. And from the other strategies menu, let's add bear calls to our available tabs. Click on Save Configuration. And if we go into bear call credits and we go into search, we have the initial value search as a default, the weekly bear calls, and then the VIX weekly bear call screen. So nothing's, because it's 2 to 10 days. With the VIX options expirations, it's a little bit different, so I might have to expand that a little bit. I'll take a look at that, but there is a bear call screen that Ernie created. He created this search and tested it, of course, but he created this search back in those time frames of 2017 and 2018, before the VIX started going really haywire, because we were, I don't know if you're trading during those days, but at some points during 2017 and 2018, the VIX was at 9, 10, 11. It was just staying there, doing bear calls at the 12 and 14 strike or 12 and 13 strike. That was also when they only had the standard Wednesday expiration and not the weeklies. So he adjusted that when the weekly started to come out with that weekly search there. I'll definitely take a look at that later on and see if I can adjust some of those criteria there for better results. But that's just a discussion on what I wanted to have about the VIX. Of course, you can see a lot more in-depth discussion on that. Let's go to back to the YouTube channel. And if you just search on our channel using the magnifying glass, I think let's just do VIX. Let's see what comes up. It's now the right time to buy VIX calls from 3 years ago, trading UVXY or VIX for portfolio insurance. Covered calls or collars on the VIX, well, you can't do that because you can't buy the shares, so you got to consider VXX or UVXY in those cases. A look at the VIX currently. So yeah, those first two videos is now the right time to buy VIX calls, discusses our approach with that. And again, trading UVXY or VIX for portfolio insurance, which of course happened around our Halloween expiration a couple of years ago. So those are a couple of ones where you get some more in-depth insight as to what we use for a market hedge. With VIX just below 14 is now the right time. It was pretty a good time if I remember that conversation and how that went as well.